excited to be here. Being a part of the Bogleheads meetings are a great pleasure for me. Mostly really because, it actually, kind of started out, or it actually kind of happened by mistake earlier this year when I got a call on a Friday night that that Taylor and the group in South Miami, they needed someone to come speak, and I was actually one of the only persons registered in Vanguard in Florida to be able to speak about our product. So I went down. We had a great engagement, and it was really exciting time. So since that time, I've been able to interact with probably 4 other chapters, and actually scheduled for about 4 more next year, just covering broad topics and giving some kind of general education, if you will, as we kind of go through several kind of topics, which we think is pretty important. That being said, today we're actually going to talk a little bit about international investing, and some of the thoughts and views for Vanguard, and maybe a good way to kind of start this out, I think, would be to tell you a little bit about my experiences leaving the U.S. to go to Asia to actually work at HSBC. And a couple of things really popped out to me when I made the trip. And typically when we're on like these executive kind of trips, you have a go look see. So that's an idea of you going, taking a look, understanding the surroundings, all those different things, and then you make the permanent move. Well, my wife being in her family being in the military, she actually graduated high school in Okinawa. And she said, nope, we're just gonna go dive right in. And we took a night flight, arrived in Hong Kong, and it was such an amazing thing because it was a city in the midst of hills, in the midst of things that were so dynamic. And I get to my apartment, and I really couldn't understand a lot of things. One was I was larger than the refrigerator. The stove was half the size of a regular stove. The bed was literally right at my kneecap level when I'm used to a bed being more closer to the hip level. All of these different things really taught me something pretty important about international life and international investing, if you will. And the one thing is that some things just may not look the same, but they do provide some very similar functions. They do provide some things that you can identify and connect with. So as I had to be kind of pushed into it, I would ask you, let's be open in this exploration as we talk about international investing. Manish, you're good to go?
Yep.
Okay, great. So one thing that when we get started, I'm not sure if you all actually have seen Boglehead's guide, but there's 3 investments that they recommend, the 3 fund portfolio. And believe it or not, one is international. And that's what we're going to talk about a little bit here. Okay, so let's move forward. So when you think about more broadly, and when we look at just general statistics, a few things that I wanted to set a little bit of context around, and that has to do with just general GDP, especially when you look at pre-COVID versus currently in the midst of COVID and what we might be looking at, going forward. And the one thing that I do want you to note is a few things on this particular slide. When you see this first line where it says VMO, that's Vanguard Economic Market and Outlook. And these numbers around GDP, or annualized GDP for 2020, was originally set in November, December of 2019. So this was our original estimations. Then since then, we have what we call our base case, given the recent updates in COVID and in markets and in the corrections. And what we try to do at Vanguard is we don't try to pinpoint an economic prediction, but we like to give what we call this base case, upside and downside, a bit of a probability range. But from an economic perspective, what you need to know, and what I really want to point out here, is that look at the variation between countries. And this is an important point around just general diversification. And what we believe, Vanguard, looking on a 10-year outlook, is that China is essentially going to outperform. all other countries, and even if you look at base case, you look at upside, downside, there's various diversification that you can see and performance outcomes across the board and across the world. So this is a global context that Vanguard really likes to set out and give a real clear kind of picture around, like, what are we dealing with? What are some of the outlooks? And why does international make a little bit of sense? Why does it start making sense? Is that all economies are not the same, okay? Here, so when we start looking at going forward, if on the previous slide, you look at GDP for the year and estimates, the idea is that most regions will have this V-type shape correction. But this slide here actually depicts something very interesting and something very different. Is like, how does the recovery happen, and how persistent is the recovery? Because when you start looking at trajectory, some of the trajectories actually it's going to take up to 2022, 2023 to actually close in the gap between what was pre-COVID and what was post-COVID. The interesting point here to note again is that essentially in Asia, China is essentially going to be back on track with their trajectory of GDP almost by the end of the year, if not a little bit earlier. Now, we can talk a little bit about some of the reasons why and why we think this is occurring, and in even the relative positions around US and Euro. But you can see, again, the economies, even going forward, there is a difference between their performance and what they'll be able to do and how they're going to be able to perform going forward. Michelle, I'll take a pause right now just to see if there's anything that.
There were some questions about how trustworthy some of these numbers might be coming out of China, especially. And there are some other questions going on. So, okay, has Vanguard modeled a double dip recession, for example? How long will that recovery take? Yeah, etc.
So this is a great question. This idea of trustworthy and confidence in the numbers that are coming out of China. And I think that's one of the elements around when you think about international investing, like how transparent, how authentic, how accurate is the data, and can we have true confidence in it? And I'll answer it actually in two ways. One is that I'm not sure if everyone on the call actually knows that Vanguard has an office in Hong Kong and in Asia, where we are functioning as a full-on business there. And here's the point to note. About 3 weeks ago, we had a call with our chief economist, Joe Davis. We also had our economist, Chan Wang, who is in Hong Kong. And then we have another economist that's in Europe. Out of the 3 economists that we had on there, only in Hong Kong are they actually back to business. They're back in the office, actually functioning as a business. So this is a little bit of a distinction between the U.S. and what might be happening in Asia. So that's kind of one element of it. There's a bit of a testing of it to say, well, what's actually happening on the ground relative to the numbers that they're reporting. Now, is this all of China? Is this the entire region? The answer would be no, but I would tell you that my second element of this is that when I traveled and worked in Hong Kong and in China, this was around 2004. So this is slightly after SARS that they had. And it was a very interesting thing that I think just from a cultural standpoint, I didn't truly understand or appreciate. And it was that when someone, felt sick or anything of that nature, they often were really, quickly to wear a mask and to, kind of, and this is whether it was something really serious or if it was a light, mild cold, if you felt like that was the case. And I say that is because it's a little bit indoctrinated from their previous experience, but also it's just a part of what they have learned over time. And I think that bodes a little bit more into the confidence levels. It's not to say that they're not going to have their troubles or struggles. It's to say that there's some history that they've kind of learned and experienced. And when it comes to GDP numbers, Vanguard's very confident in our statistical model, which is a proprietary model that gives us a 10-year outlook. We're very confident in the actual numbers when it comes to the GDP and economic outlook. But just from a broader cultural kind of perspective, I wanted to highlight just kind of two experiences that kind of validate a little bit of what we're seeing in the numbers on these charts. So this is a really interesting one, and I actually added this one around this index of general uncertainty. It's more of a global phenomenon that we're dealing with versus just maybe a country or just a region phenomena. But the major point that I would like to highlight here is that the level of uncertainty has truly escalated beyond anything that we've seen in recent history. So to that point, that's going to drive a definitely what I would say anxiety around where do I go and what do I do, especially when it comes to investing. More broadly, you kind of think about it on a day-to-day basis. You just even think about like we're right now just before this Thanksgiving, and the question of like what do I do and how do I do it? This level of just general uncertainty and levels of decisions just drive the anxiety, whether it's through our day-to-day decisions, but even more broadly international. And then I can think, you start thinking about just broader geopolitical issues. It just feels like there's just more uncertainty and anxiety that's just residing more naturally. So if you're feeling the uncertainty, the issue here is just highlights that it's more persistent and more global than we've ever experienced. And this chart kind of just highlights that broader point. I thought it was important to raise this point, because when you think about where we are in the middle of the crisis and the pandemic, this is a part of what's fueling, general decisions that a lot of people might be making, whether it's relative to international or domestic. This is a part of that anxiety that resides there. So I just wanted to make, just make a comment just around that general driver. Okay, so a few things I think that are important to help continue to set the broader prospect is just around global and macroeconomic outlook. There's a couple of things that I think are very important to note. And one would be just the variation around sector variation. So you think about certain sectors have been able to recover versus not. So where there's social distancing and whether it's certain parts around manufacturing or construction, this works and this is starting to come back. Where there's not more retail face-to-face, there's struggles. But what that means globally is that if you start looking at the dynamics of a region, you can see that there's diversification, differences in magnitude of those representation segments within the world. What do I mean by that? You can look at US being more tech driven versus China, for instance, potentially being more finance or manufacturer driven. So you can see that these recoveries and how the markets are going to recover gives some credence to what's happening at the sector level. The second broader piece is that we definitely believe that there will be broader loosening and continued loosening of monetary policy. There's going to be definitely effects, especially around all of the borrowing. But what we're willing to state is that in line with the Fed is that loose monetary policy will continue for the foreseeable future. That leads into 2021, potentially 2022. But just that accommodation, Vanguard's broader view definitely sets well there. And then this idea finally around like consumer price inflation will potentially just remain weak on an ongoing basis. So those that have some anxiety about all of this pent up demand, and then the return after this pent up demand is like, it's going to pour, and then we're going to see this explosion of inflation. A couple of things we think are going to be, how would I say, headwinds for that. One is just the continuation of technology. But two, we don't believe that all of the pent-up demand. We believe that it'll be a much slower and more gradual closing there. Manish, I see you're on. You have highlighted a few things.
No.
Okay.
Actually, on the previous slide, there was, maybe you can clarify one thing. What does uncertainty measure? It's a question from Jim.
Yes, great question. So uncertainty, actually, from a broader perspective, it's more questionnaire, and it's more of this idea of what's the best way to kind of put this? Here, so this will probably be the better way. It actually just measures this idea of investment and taking potential, specific actions. This idea of, like, are we seeing more holding out of investments versus coming into investments is really the broader kind of metric behind the general uncertainty. Thank you. So a couple of things I want to highlight here, which I think will be really important for us, is just around equity markets and what's Vanguard's broader projections. A couple of things that we believe, as you can see, around how we go about measuring returns, and especially around certain standard deviations and where the mean. What we are seeing is that international, we believe, going forward on a 10-year outlook, will have a strong propensity to outperform domestic. From a projection standpoint, we see that the U.S. will actually land somewhere between 4% and 6% returns, and then for international, we're looking at anywhere between 7% and 9%. Some of the drivers behind that is definitely around what we believe to be valuations and the corrections of valuations, and just more broadly, that upside that we're seeing from the international perspective is how we're kind of forecasting that range around, outcomes from U.S. versus international. And this really speaks to some significant points of it. If you can just take a look at, just from the well, just starting on the left, you look at, there is what we call the PE ratios and ratios that exist, like price to earning, and one of the elements that we think are helping to explain a little bit on why we believe the market is fairly valued is largely due to just low interest rates. And we can talk a little bit more about that as we move forward. But when you think about this, exactly the exact same thing, jumping over to the next chart on international versus US, this valuation levels, we're seeing that there's a slightly benefit to lower valuations in international, which gives some credence to the upside, and really kind of explaining a little bit why we have the projections that international, is likely to, in a 10-year perspective, to provide better returns than what the U.S. Now, I can probably feel the tension is that many people, we've been saying this for 10 years, right? And is this truly this time different? But like I said, I think, more broadly, we just have this 10-year outlook that these things will hold true between U.S. and domestic markets. And we can, like I said, we can talk a little bit more as we kind of move forward.
So Paul,
yeah.
So on your previous slide on expected returns, there was a question. So on the 7 to 9% expected returns from international investments, is this for the rest of the world, or is this for a particular geographical region or industry?
Oh, great question. So we believe this is for more broadly for the rest of the world. So we would do US and international. So this is more broadly. I think if you look at the market cap, especially if you look at Asia and the difference between Asia and Europe, you're probably going to see some different variations around what we believe to be outcomes there. Probably with Asia, having more outperformance than what we would see from a European perspective. But for this particular chart, this is everything ex US.
Great, thank you. And there was previously a question from Mel Turner that I was holding on to, but maybe you can address it either now or maybe in the next few minutes as you go along in your slides. And this is a question from Mel, which is, you started to talk about the increased returns from international investing potentially. So the question is, should your main reason for investing international be for returns or for lack of domestic correlation?
This is a great question, and I'll hit on a little bit of it now, and then I think there's a few slides that that'll give a little bit more clarity on that. So the first thing is that the point around lack of correlation. There's data and points that would say maybe pre-1995, if you will, and I'm stretching it back a little bit, but you would have seen correlations, probably in the 0.5 range. But since 1995, the correlation has been literally increasing, year on year. And this speaks to a little bit of why people might, have struggles with investing international. Right now, the correlation is really as high as 0.8. Perfect correlation is 1. I think you guys know that. But the correlations have been driving up. But we can see that there's still diversification benefits. So a part of the answer is that there is diversification benefits, and two markets can actually provide exposures to two different kind of conditions. And even if you consider the previous slides around GDP and outlooks, you're going to see that not only regions will perform different at different times, but also the makeup of those regions will also be different. So there is inherent diversification that we believe is truly beneficial, so that at some points and at different times, both of these markets can be, one can underperform, the other one can be overperforming. So you can experience that diversification benefit. But what we also believe is that, when our general projections is that because of valuations, we believe that international has more upside. So the answer is a little bit of both, and it's not just either or. But that's a great question. This is a very interesting slide here. Just that the crisis has shown some general differences between the various regions, and if you can take a look and just absorb a little bit of that difference, and probably what I would note is how you can see the differences from China to literally all the other developed markets, and their overall equity performance that they've illustrated, and this is really in time of deep distress, right? So from the blue part, where when people think about, hey, what's the downside to international investing, I believe that might have been one of the questions. Well, downside or what's going to be painful about it is really around variation, and this idea of how much can a particular security go down versus how much a particular security can go up. And when you look at this, I think what you can see is that there's exposures, and this one is more probably related to just recent events and how the crisis might be handled versus more broadly. But what you are able to see is that how does different regions perform under certain stressful and we can probably say extremely stressful events or continued stressful events. And this is another element of why, like, global diversification can really have some value in your portfolio. And the idea really behind it is that, actually is like, how do you reduce the risk that's in your portfolio? And international definitely can help you do that. And we'll get to a couple of points that will talk about, well, how much and some of the more nuanced questions around that.
Paul, one clarification on the investment returns as well as these numbers that you're showing here. Are these dollar adjusted? Are they currency adjusted, or are they native currency returns when you talk about in all of these slides?
Oh, and all of the slides. These are actually dollar adjusted slides, so they're not native to their to the foreign currencies, which can lead to that. That's another good point around just foreign currency that we can definitely talk about.
Thank you.
Okay. So in investing globally, when you look at this, this number here that we have here is around 2015. The number as of this year and probably even closer to this month is more around 55% when it comes to U.S. representation versus this 53 that we have here. But the idea around investing globally is it too big to actually just ignore, right? Is this representation? If you start out with a basic market cap globally, you're essentially missing out, upwards of, in here, this case, 40, 47, 45% of the global market that's out there. And that representation is a question you have to really kind of resonate with. And part of this is that what's represented in the 47% that you potentially could be missing out on versus just staying U.S. domestic. There's a couple of stats on home country bias that I think it's important to kind of note, is that the typical U.S. investor, they have about 1.5 overweight in U.S. in their home market. So if it's 53%, they typically will have 1.5 times that weight in their overall portfolio. So there's some international exposure, but they definitely overweight the U.S. And the likes also go for international investors. So if I was a Canadian investor, it would represent that I would have a much smaller percentage of my portfolio being local, and a significantly larger percent that would be towards the US. But those biases also exist both domestic and international. But like I said, the question that we can highlight a little bit is that, hey, what's in the 47 that really could be something that I could be missing, or and a diversifier away from what it is that you have in your portfolio. And that bleeds a little bit to the chart below. If you look at the chart below, and you can kind of see the various sectors more broadly, you can clearly kind of see between U.S. and international the weighting and why, and again, why diversification would drive through in that piece, and definitely between U.S. and just the rest of the world. It's like they're not equally weighted just across the board. This one just really kind of highlights some of that diversification there.
Paul, one sort of question here. So when we talk about the long term, I know previous slides mentioned outlook over the next 10 years. Now, when we talk about the long term, what should we be thinking about in the long term in general, right? So like you said, the last 10 years haven't been very good for the rest of the world. When we look forward, should we be looking at 10 years, 20 years? What sort of time horizon should we be thinking about when we think about diversifying internationally?
Yeah, so I would say there's a few things, and I want to be really kind of thoughtful about that. One, I think you have to be incredibly aware of where you are in your where you are in your investment life, if you will. Are you an accumulator at this time, an early accumulator? Are you in the final stages or approaching retirement or in retirement? And here's an easy tip and a kind of a point that you can make. And I'm not sure if everyone's heard of like target retirement date funds, right? But these are funds that actually manage the asset allocation over time by professional managers to help an investor, if you will, calibrate their risk and returns relative to where they are in their accumulation to retirement stage. And why do I bring this up is that can be a model. So Vanguard has them, Fidelity, like any company has them. You have to think about like more broadly, where is your kind of ideal retirement, and look at the allocations that are underneath. You can actually see that, right? And to me, this is an important point, because to state that, hey, what's the time horizon I should be looking at? It kind of depends, because you can easily see that in an international space, that adding that additional risk when to retirement, it may not be, the most prudent thing that you would want to do. But when Vanguard says what's long term, how we're thinking about it is really in 10-year increments, right? So if you are, I would say if you're 10 years away from retirement, you can, this idea of what you add into your allocation is something where international can be definitely considered. Now, Vanguard has a view on that, and to be honest, I and thinking about it a little bit clearer, even in the three fund portfolio, Taylor mentions a particular percentage around this allocation, and I believe that this long-term view of 10 years is really important. And he definitely says, hey, at maximum 20%. And the counter to that and the investment strategy for Vanguard is saying, hey, at minimum 20%. And I think that these two sides give you a little bit of a view on what it might mean to add some to your portfolio. But for sure, 10 years, I would be very thoughtful about that. Is it necessary to have international if you're well into your retirement years? Look, there's going to be more volatility that'll play in, and you have to think about your own particular risk tolerance. So hopefully that answered the question there. Okay. All right, so moving on, looking at it a little bit more. So this gets back to I believe an earlier question around volatility and what we mean by long term, this idea of 10 years. Global volatility is actually lower outside the US than it is within the US. So this idea of this additional global, broadly diversify and how do you reduce volatility in your portfolio? This is where broadly the case is that it makes some sense if you're concerned about internationally. Is there going to be transparency? Are we actually getting valid numbers? The proof here is that from a data perspective, that volatility on a broadly diversified portfolio ex-US or outside the US is going to lend to a reduction in volatility in your portfolio, versus what some might believe is like, hey, it's just more volatile. And note that this is a broadly diversified portfolio. When you're talking about ex-US, you're talking about Europe, you're talking about Asia, and the likes, which will be more broadly, or even okay. And so this is really just a statistical example and really highlighting, hey, what's Vanguard's belief in broadly investing international, and this is a representation of what your equity only side of the portfolio is, right? So this idea of taking, if I'm just at a 50-50 portfolio. Vanguard now talks about like, hey, what's the percentage of that 50% of my portfolio should be allocated between U.S. and domestic. So these numbers are not for your entire portfolio, but just the equity position. And where we see that the diversification and the risk reduction starting at 20% and essentially because our latest recommendations is really between 30 and 50%. Where we see the value. So we've actually suggested higher allocations than what this chart would even illustrate here as the benefit to driving down that risk in your portfolio when it comes to the variation and the variability that might appear in your portfolio. And I believe this is the final slide, and we can definitely get to some of the specific questions. And I have actually 2 slides here, but if you look at this really just is showing you this idea between domestic and international, when it's outperforming, when it's not outperforming, and really even highlighting some of the difficulties that might exist to actually trying to predict when it's going to happen. Because I think the idea is like even in a domestic market, we take the same strategy that we don't know which sectors are going to outperform. We know that some will do well. They're just like, for instance, now you think about tech really storming through. We don't time the market and try to figure it out. We say just buy the market. And this same idea and this same financial concept exists globally as well. So the difficulty of trying to say when it's the best time, the idea of one, can you access the general international market at reasonable prices, and do you have confidence in the management of that particular fund that you might be selecting? So there's an idea that some active international investing might have some more possibilities, but of course, again, Vanguard, we believe just in the general outlook. And this is just more recent, which gives you kind of a month-on-month look. And mind you, the slides kind of flip. So if the last slide, domestic was on the top, domestic's on the bottom this time. If you can't read it, they're a little bit light there. But I just wanted to show you, you can see again just the variability and how difficult it is to time in and time out of the market. Thank you.